Residual income is the amount by which operating earnings exceed a minimum acceptable return on average invested capital. So we calculate residual income by taking operating earnings minus minimum acceptable return times our invested capital. We'll look at an example on the next slide. So how residual income avoids some of those ROI criticisms is that we look at whether or not we're going to take on this project. We have an opportunity to take on a project that has expected operating earnings of $55,000. The invested capital is $500,000. So the return on investment of the individual project is 11%. So we can see if this manager only is looking at the ROI of the division and how it's affected, he would have rejected the position, the investment. But if we look at the residual income with and without the product or the project, and he's being evaluated on that measure, he is more likely to take on this investment, and that would benefit the entire organization. The other measure we have is economic value added. So this is also called EVA. This has become a very popular way to look at performance evaluation for compensation plans. We can use this for individual divisions or an entire company. So when we calculate EVA, it's the after-tax operating income minus the sum of a division's total assets to their current liabilities, and then times the weighted average cost of capital. Other ways we can perform performance evaluation is with a balanced scorecard. So when we look at total quality management, we look at quality across the entire value chain. So when we look at the value chain for our cookware division, we have the supplier, the manufacturer, the wholesaler, the retailer, and the customer along the supply chain. So we can make a balanced scorecard to look at performance evaluation of these various pieces of the value chain. So the balanced scorecard is performance measurement that looks at the company's strategy, the company's goals and objectives, and then provides measures towards those goals. We have 4 different components of a balanced scorecard. Balanced scorecard has a financial perspective, a customer perspective, business process perspective, and a learning and growth perspective. We can look at each one of these individually. We're going to see an example here of what things we might measure under that perspective and the different measurements that we might have. So with the financial perspective, we're going to use financial ratios to analyze those, along with return on investment, EVA, residual income, etc. Under the customer perspective, we're going to look at what is our customer retention, our customer satisfaction. The business processes perspective, we might look at how much scrap do we have? What are our cost variances? How well are we doing with production times and like our manufacturing cycle efficiency? And for learning and growth, this looks at, are we creating new products? Are employees happy? Are we retaining employees? Are we training employees? And how are our employees performing? The financial perspective looks at the company through the eyes of creditors and shareholders. So we have financial measures, financial analysis. The balanced scorecard should include both financial and non-financial measures or performance. The customer perspective is making sure that we're meeting our customers' needs. We are going to look at if our customers are happy, our customer retention, how many customers are using our loyalty or rewards program, our customers, were they filling out surveys that they're happy, have we increased or decreased our market share, business processes, what are the relationships with our suppliers and distributors, um, any profitability measures, how many warranty claims have we had, how much scrap do we have, how much downtime and defects, and then learning and growth perspective. So do we train our employees? How much focus do we put on training our employees? Are our employees satisfied? What is our employee retention versus our employee turnover? How often are we having to hire new employees because we can't keep our current employees? Some of the difficulties in using a balanced scorecard is that sometimes it's really difficult to develop those measurements, so those baseline measurements for some of those things. So what should be our base employee satisfaction measure that we are looking against our results and our actual? The financial perspective section is the easiest one to measure because we have all of the financial analysis tools to do that. However, some of the other information is not as easy to set benchmarks for. The last thing that we talk about in this chapter is how we design management compensation. So we pay our managers a fixed salary, and then we might have bonuses for them. There could be other types of incentives, especially as we get into the higher ranks of really large companies. Other incentives can include life insurance policy, automobiles, personal use of company assets, apartments, aircraft, box seats to games, and different things. Those types of incentives vary from company to company and to level of organization. Most companies have paid life insurance policies for salaried employees. Whether a company includes a bonus or not really depends. And then how do we structure those bonuses? One of the things that we want to avoid is structuring bonuses on measures that encourage our managers to commit fraud. Um, so we think about other fraud that's been committed. So if I say that if they have a substantial increase in revenues over their expenses from one year to the other, they might be inclined to not record or not follow the matching principle and record actual expenses. And there are other ways to make the way that we shift money, shift other things. Things that when we're creating those incentive composition systems for managers, one thing we want to have a variety of measurements. So we saw what happens if we only do something like return on investment, that we incentivize managers to not take on capital investments that will improve the company, but not improve their return on investment. So what is the time horizon? Is it a fixed bonus or is the bonus variable? So do we have a higher increase if we have better results? Is it stock-based or accounting-based performance evaluation? So we're looking at if they grow the stock market price or grow other measures that affect the stock market price, or are we purely looking at difference in net income, our financial performance ratios? Also, do we only reward division performance, or do we look at company-wide performance? Where do we put in those incentives? And then are we looking at competitive incentive plans where we pit divisions against each other and whoever has the best wins, or do we increase cooperation by doing company-wide performance? And if the company as a whole performs better, then everyone wins. So that comes down to this ethics and fraud. So companies can compensate management with things like company planes, luxury sport boxes, etc. But they have to include those in their notes to financial statements. They're also included in the taxable income of the management. So that's one thing about incentives that a lot of people don't think about. So, for example, if your company provides you something um, that you use for free, they have to tax you for that somehow as if you were receiving it as salary. So we have to make sure that we're not committing fraud in the incentives that we use, and that we're not creating incentives that cause our managers to commit fraud. So these are all different things to think about when we're looking at performance evaluation and we're trying to evaluate how well a division is doing and whether we're going to keep a manager on or not. And that is the end of chapter 25.